Futures right now just in the red a little bit for all the three indices that we followed. Joining us now, Carol Schleif, Chief Investment Officer of BMO Family Office. Carol, we have seen new highs, obviously, but it seems like the pace of the advance has kind of moderated a little. In your view, there's been a lot of things that the stock market has had to kind of come to grips with and recalibrate. And it's done it. What are, for example, geopolitics, the election, hurricanes, strikes, all these things. But it's held up, which means a soft landing is intact?
We've always been in the soft landing camp, never really bought into the fact that you have to have a recession just because from a calendar standpoint, like a lot of people were suggesting that we had to have a recession because we hadn't had one for a while. But no, and the most constructive underpinning, if you will, for markets is not only having the solid fundamental underpinnings keep coming through, but markets continue to do that grudging climb higher in the so-called wall of worry. And that, as opposed to when you have exuberance and everybody's really over their skis leaning into risk, those tend to create a lot of bubble territory. But this grudging climb higher where people keep focusing on fundamentals, the great part is we've got the next 4 to 6 weeks chock full of fundamentals coming from company earnings.
You think the numbers won't surprise us this week on inflation, I guess. And go ahead.
No, I was just going to say, no, we don't. We think inflation will continue to come in. You know, the interesting thing is it'll be really tough for the Fed to get that core inflation down because housing is such a big part of that, and services, of which insurance is part of it. So now with the hurricanes, with the wildfires that you've got in the Midwest and out west, there'll be pressure on that will keep that there. So it keeps it intact in terms of the Fed's got to be cautious in continuing the rate decline or the rate cut scenario, although we think they've got plenty of room between where the policy rate is right now and where inflation is. But it's going to take them some time to get that core rate down.
But that's what's kind of weird. So the core rate's going to have trouble coming down. The jobs number was much stronger than expected. Why does that give the Fed the ability to continue to cut 25 basis points? How do we even know that the first one wasn't a policy error, especially after you watch the 10-year and the 2-year yields have risen since the Fed cut? I don't know whether the market's trying to tell us something or not, but you'd say stay on track, keep going 25 basis points every time in a strong economy with the market at all-time highs?
Well, I think the piece of it is if you look at where the Fed was, they went to 5.25 over a year ago when inflation was running at 8-9%. And so that 5.25 with inflation running, even the headline inflation now is down closer to 2, but the core closer to 3, you've come down substantially in that. So the policy rate itself is still on the restrictive side. You've got an economy that's following through that anyway. You've got some support in jobs numbers. You've got reasonable GDP coming through. So the Fed has a little bit of room to come down in that policy rate yet. We wouldn't suspect that you'll go on a 25 basis point every meeting and stay there, but they've got a little bit of room in there still to be supportive of that and to see how things go, because as they talk about all the time, the long and variable legs, it's going to take some period of time to see how it works through.
And as pointed out, the interest payments, because Yellen has kept everything short term, which, you know, when rates go up, it's not great. So $950 billion. Interest payment versus the defense budget is $826 billion, in Medicare $869 billion. So just to sit here at rates at these levels has cost us $950. It's rough. So it's probably good if we can come down.
Right. That piece is good. And, you know, the 2s and 10s are really starting to reflect the fact that the understanding that the economy is stronger, that you're going to see that strength. So uninverting that 2 to 10 curve is telling you that the bond market says there is some growth there that they're going to be watchful of.
Okay.